please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi, welcome back to the show. Although the market may be flat, there are plenty of stocks moving around and we're showing them to you on our ticker. But I just want to point out one pocket that's doing well is NBFCs this morning. So, you know, you have your names like LIC Housing Finance, Bajaj Finance that have once again come back onto the traders' buying list. Let's see how that shapes up. But for now, that pocket's looking pretty good. So it's a flat market, but the good part is at least there's some buying action. You spoke about consumption. Now NBFC is also picking up.
Yeah, consumption is doing well and NBFCs too. But, you know, Sonia, the only problem about this rally that you're seeing right now is that it's been driven by stocks which have fallen the most, essentially short covering. ICICI Bank, SBI, Yes Bank, they are leading this this move up. You know, if you're a bull, you would rather hope that, you know, it's stocks like HDFC Bank, Kotak, the world, which take the market higher, because this kind of move in, you know, some of these corporate facing banks sometimes does not sustain for too long. So that, I think, remains a bit of a risk. And, you know, there's a chance that this bounce gets sold into by the end of the day.
Yeah, you are a bit skeptical when laggards take the market up in the near term, right? Some news flow coming in on Syngene as well. They've signed an R&D agreement with GSK. Interesting there. We'll try and get more details, but for now, the stock is up about 0.5%. We also got a lot of market opinions through the course of the last few days. We spoke with Jonathan Scheisel of Ashburton. He's a big investor in the Indian markets. We tried to get a sense of what he made of the US-China trade war, as well as his views on the Indian market and on banks in particular. He likes SBI at current levels. Listen in.
It is important. It seems China seems to be quite, constrained in its responses thus far. But I think, yeah, I don't think one can be too complacent here. It could easily get out of control. We've been fairly optimistic about this global recovery, that we still believe we're fairly early into a global recovery. Obviously, a global trade war could easily derail this recovery. So I guess that's what equity markets are trying to price in, the risk of a major global trade war. I still think anybody with a slightly more longer-term view, you know, there's better value in that space now. And certainly if we hadn't already put additional monies there, we'd be looking at the moment. Again, you know, in the short term, there's probably more downside to come in some of these names. We had been sort of cautiously upping our weights of certain financials, particularly the corporate banks. I think when you look at the valuations, we've seen quite a brutal and very fast derating of the private sector corporate banks, as well as obviously the PSUs. When you look at State Bank, for example, where it is on a price-to-book basis, and you know, yes, there's a lot going on. Clearly, a lot of government policy still seems to be coming out. RBI policy, we're getting new stuff all the time. It feels like we're reaching a point where perhaps these things will bottom out. But as I said, anybody with a slightly longer-term view with the current valuations that we've got in those areas, I think it's not a bad entry.
Okay, right on cue perhaps, not a bad entry point for SBI. The stock is up in the green today. But let's talk about some IPOs now. Hospitality chain Lemon Tree Hotels, the IPO is open for subscription today. Let's find out more from the management. Very interesting, this one. Patanjali Keswani, the chairman and managing director of Lemon Tree Hotels, joins us now. Mr. Keswani, good morning. What's the expectation from the issue in terms of demand, investor appetite that you're getting? Give us details on the portion that you've already raised from anchor investors ahead of the issue.
So, well, as you know, we announced our anchor investments on Friday. Now, the issue size is at the top end of the price band. Since we are pricing the issue at 54 to 56 rupees, we are expecting at the top end of the price band to raise 1,039 crores, which is a sale of about 23.59% of the company's stock. This is entirely an offer for sale by existing shareholders, including Warburg Pincus, which is a private equity fund, which invested with us way back from 2006 onwards. We've had our anchor issue has been oversubscribed. We've raised 311 crores. We've got a very interesting diversified base of investors, both domestic and international. The vast majority are long only, so some of the anchor investors are like SBI Mutual Fund, HDFC Mutual Fund, Aberdeen, the Royal Bank of Canada, TT International, and so on. So in total, I think there are about 19 or 20 anchor investors.
Okay, Mr. Keswani, good morning. So, how much will the prominent investors like Warburg, etc., be diluting via this IPO?
Yeah, so Warburg has a total stake of a little under 25% in the company. As I said, they invested between 2006 and 2009. So they are selling about half of that. The rest are by some early investors who invested in the company at around the same time. So I promoted this company in 2002, and many of these investors came in 2004, 5, and 6. And so it is an offer for sale for ensuring some, they are exiting some of their investments in the company.
Okay, so since this is an offer for sale, what would be the capital requirements of the company now?
See, well, if you look at Lemon Tree today, we have about 4,700 rooms which are operating, and we are adding another 3,000 rooms in the next 3 years. And of these 3,000 new rooms, 1,600 are owned by us. Now, the investment is 1,700 crores in these 1,600 new rooms. We have already invested 700 crores. The balance will be made up a little bit with debt and the balance with internal accruals. And at this moment, we don't need any further money in the company in terms of a primary issue. We are fully funded for this growth. And we don't see any strain on the balance sheet either with the debt that we have on our books. So actually, the company did not require any money. And the real reason for going public was, of course, to provide exits and liquidity to shareholders, to also enhance our brand visibility. These were the two reasons.
Okay, the company has been growing at a good CAGR, 18%, but is this sustainable?
If you look at Lemon Tree, since we opened our first hotel, we've grown at a compounded annual growth rate of 44% in supply terms till 2017. And then now, of course, our base is large. We are currently India's largest mid-market hotel operators and owners of rooms. And if you look at our pipeline, as of today, we are going to grow at the rate of over 20% a year for the next 3 years. And obviously, as we grow larger, the base effect comes into play. And while in absolute terms, we may add a lot of rooms, in percentage terms, it will obviously not be as large as it was in the past. It won't be 44% a year.
Okay, I do hope you add a lot of rooms. I have stayed at your property in Goa and I really enjoyed it. But after you've been reporting losses for the last couple of years, finally you've turned profitable in the 9 months of FY18. Do you see it get better from here?
See, the question is, I think not only for Lemon Tree, but for any other high growth company, is how many operating hotels do you have which have a positive cash flow, and how many new hotels are you adding which typically take 1 to 2 years to stabilize. So if you look at us in the last 5 years, which was actually a very stressful period for the hotel industry in India, because supply was exceeding demand year on year and prices were therefore remaining stable, or in fact occasionally going, were not growing at all. In our case, 40% of our total inventory was added in the last 5 years. So really, if you look at it from a very, well, I guess a simplistic perspective, 60% of the hotels were generating profits and 40% were new, which were yet to be stabilized. So obviously, when you go through a high growth phase like that, and that too at a time when the industry is going through stress, the new hotels take time to stabilize and are a drag on your profits. So in the last 5 years, it is, we did make losses for 4 of them. But I think the real metric we looked at, as I would expect any investor to look at, is the cash profits of our company. Now, if you look at the hotel industry, hotel assets are appreciating assets. They don't depreciate over time. In fact, they only increase in value because replacement costs increase. So depreciation in that sense is a tax benefit because you don't need to replace the hotel. And the cash profit that I'm referring to is PAT plus depreciation. And if you look at that number, then we have been cash profit positive for except for 2 years when we opened, I think, 12 hotels, we have been cash profit positive for our entire history. And going forward, well, I don't want to make forward projections on how our profitability will improve or not. But with the expected improvement in demand in our industry and the slowdown in supply because of all this trauma in the past 5 years, we expect the economics of the business to only improve and not deteriorate any further. So from our perspective, we are very optimistic about the future.
Okay, a significant chunk of your revenue comes from owned hotels category. So would you look at scaling up the management contracts or owned hotels on leased land?
Well, keep in mind that typically, and I'm speaking very rule of thumb, for every owned room you have, you need 7 managed rooms to equalize the profit. So typically, if you make 100 rupees profit from a room, the management company will take 14 rupees. So you need 7 rooms for a management company to be equal to the profit of 1 room if you own it. So clearly today, since a majority of our hotels are owned by us, the income or the profit that we earn from our managed portfolio is not really significant. But going forward, our strategy is that we feel that our brand is now well recognized across the country. We are already in 28 cities. We are expanding to 50 cities in the next 3 years. So going forward, clearly what makes sense for us is to monetize our brand and our platform, and we are very clear we will go asset light. We will look at managing / branding other people's hotels, other owners' hotels, and that is the future for us.
Okay, Mr. Keswani, thanks a lot for your time today. That's Lemon Tree. We all know, good brand, of course, very good brand recall. But the problem is that, and this is what happens in bull market, right? They don't need the money, but IPO is to provide exit to some investors.
Yes.
As Warren Buffett once said, you should not ideally be investing in IPOs because someone who knows more than you is selling. Of course, not always true, but just some of these IPOs do bring that kind of thought process to
And I mean, these hotels are good, right? We've all stayed in some of them, but then this pricing is a bit expensive. There's not much left on the table for investors.
Yeah,
so I don't know how it shapes up.
Yeah, IPOs go through 4 phases, right? Good issues at good price, then good issues at bad price, bad issues at good price, and then bad issues at bad price. I mean, that's the kind of phase. I think still a good issue, but perhaps at bad price, as you say.
Okay, well, let's talk about some stocks that have already listed, right? Big moves coming in on Cadila this morning. Dr. Reddy is also in focus, and who else but Ekta is joining us to tell us the latest on that. Ekta, it's positive news galore for Cadila this morning.
Well, yes, absolutely. 2 brokerage upgrades which have come in for Cadila. I'll start with CLSA, which has upgraded the stock to buy from underperform with the target price of 450 rupees. According to them, they find the current valuations of 21 times FY19, 18 times FY20 quite attractive. The potential earning drivers include the likes of strong US pipeline, improving India and emerging market outlook. Nomura has upgraded the stock to buy with a target price of 426. According to them, the risk reward is favorable for Cadila. Separately, they have received approval for Toprol XL generic, which is basically used for chest pain, heart failure, high blood pressure, and this is basically an approval from their formulation SEZ in Ahmedabad. It is a positive for Cadila because it also signifies the launch pipeline for them, which is steady in the US markets, and separately it is expected to be around a 4 to 5 player market where Cadila can make around $15 million approximately from this drug.
Okay, well, thanks for that. That's a big move coming in on Cadila. But as we wind down the market, Anuj, it's now actually falling a bit. So down almost, what, 25 points on the Nifty, getting further and further away from that 10,000 mark. So I guess it still continues to be under pressure.
Yeah, the problem the market has today is that it's not because of banks that the market is falling. It's because of IT today. Infosys is actually the top drag on the index today. Tata Motors is down. On the other hand, ICICI and SBI are actually doing well for this market. So it's a bit of a tricky market, and of course, on the Nifty, as we discussed, Friday's high, 10,027, now becomes huge resistance. We're nowhere near that actually now, 99.76, more closer to the low point of Friday. So